How many of you have ever used Affirm? It's a point of sale app that allows you to split up payments on an item that you're willing to purchase. So say for instance, you want to buy a treadmill, it's $4,000. I want to break that up into 12 monthly payments of $425. Now that could be 0% interest, that could be 7% interest, that could be 12% interest. It really all depends on what your credit rating is, how long you have credit, and things like that. What a lot of people don't understand though is from Affirm, we can actually start to see what the economic situation in the United States looks like and help predict where it's going from there. So for those of you who don't know, this is the Affirm landing page. This is their web page. You can actually use Affirm at a lot of different stores, whether it's Peloton, Tonal, One Sleep, Target, Walmart. At the end of your transaction, they actually ask you if you want to split this up into 3, 4, 5, 6, 8, whatever monthly payments. And there are a lot of things that they're asking you to split payments on that are not big ticket items. So think $100, $200, $500, $1,000. Those are not exactly big ticket items in the grand scheme of things. Now, why have I brought that up? Well, if you look at Affirm's earnings report from last week, this is Friday, August 25th, their shares did go up 28%. And if I actually look at the stock over here in the last 5 days, it's up 34%. So going back to their guidance and how they reported, their shares jumped and they beat on top and bottom line, and they offered solid guidance for the fiscal first quarter. Great if you own the stock, right? I personally don't, but great if you own the stock. It says here that they had a 69-cent versus 85-cent expected on loss per share, but their revenue beat $446 million to $406 million. They gave strong guidance and they reported gross merchandise volume of $5.5 billion. Now, this is where it starts to get really interesting. Buy now, pay later services such as Affirm soared during the pandemic alongside a boost in online shopping. Why is that? Because everyone was at home, stimulus checks were rolling in, people were spending, and they said, hey, this $5,000 TV, I'll break this up into 10 payments of $500 at 0% interest or 2% interest. I'll take the TV now and pay for it later. Makes sense. It's a lot like the old years of layaway where you give them $20 now, they'll hold it for a week and you can come back, and if not, we'll keep the $20. But they have been contending with worsening economic environment as well as rapidly rising interest rates. Okay, so what does that mean, interest rates? Interest rates have started to go up. They have went up since the pandemic. We're around 2.5% on prime. Now we're around 7 to 7.5%. So we're looking at a 300% increase in interest rates. What does that do for the consumer when they want to actually purchase something? Well, it means they've got a couple choices. One, they can forego it. Two, they can finance it on their credit card and pay potentially 20 to 30% interest. Or three, they can do this buy now, pay later through a company like Affirm. Despite significant changes in interest rate and consumer demand, we delivered good credit results. We demonstrate the business can continue profitably expanding in a high interest rate. There are student loans coming up. I'm not going to touch on that in this video, possibly in another one. But they pointed to growth of the Affirm card. Now, there's some uncertainty remaining around their model, but they continue to show differentiated credit performance and upside potential. From this article, there's a couple things I wanted to go over. They did make a warning that sent ripples through the landscape, and their message resolved around the current economic climate and the potential for a significant downturn. There are several indicators, when we look at that. So we've talked about the interest rates, we've talked about what Affirm does, we've talked about how they break products up and point of sale items up. Rising interest rates and rising inflation rates. Now, as things become less affordable, what do people do? Like I said, they either buy less, they defer payments, or they pay higher interest. What Affirm has seen is they've actually seen people start to use Affirm more for smaller ticket items. So things that Affirm was not offering or seeing 2 or 3 years ago on maybe a $500 purchase, people are now to the point where they're having to purchase those with something like an Affirm, a buy now, pay later at point of sale, where 2 or 3 years ago they weren't. What does that actually mean? Well, it means that the consumer is struggling much worse than the government or GDP reports would say. The government and other financial institutions will say that credit is strong, the consumer is doing well, inflation's starting to come down. It's not at all. Inflation's not coming down. It's only going to get worse. It'll get worse going into an election year. It'll get worse as companies continue to raise prices, because guess what? They can. But what's interesting from this article is Affirm is actually telling you that, hey, we do see problems in the consumer. Now, while our stock has done well, we are seeing people continue to struggle. If you look at their stock price, if I go back a month, they were trading at $13.81. Today they're trading at $18.92. So what happened last week? Well, if I go back to August 25th and I click on this article, let me actually go back here. If I go back a year, you can see where they were back in about a year ago, $26. But if I go out 5 years, look where they were during the pandemic. November 5th, 2021, they were at $164.23. That got cut by 90% off. Yeah, that's almost 83% since then. However, if I go back to the 5-day, you can actually see they were trading at $13.81. They beat earnings and their stock popped. But what does this actually mean? If I go down here, this is a New York Fed article. I'm going to link down in the description. But the increasing levels of debt, the financial instability, and the domino effect on the economy. And part of this goes back to a couple things. The first one I'm going to go over is housing debt. So $393 billion in newly originated mortgage debt in Q2 of 23. That's a modest increase in purchase originations. About 39,000 individuals had new foreclosure notifications on their credit reports, a very small increase from the first quarter. But then the other one I want you to look at is student loans. So student loan debt stood at $1.57 trillion in Q2, and federal loan payments remain suspended until October 23, and missed payments won't be reported until Q4 of 2024. So we're looking a year out before we even know people have missed payments. One thing from this is once October hits, I predict that Affirm stock will continue to go up as more people start to finance their purchases at point of sale and buy now, pay later through places like Affirm. It doesn't make, you can't keep piling on this much debt to the consumer and expect them to come out ahead. And what do I mean by that? Well, we've got student loans starting again. We've got housing debt at an all-time high. We've got foreclosure notifications showing up on people's credit reports. Again, a small increase, but still there. And then you've got interest rates that keep on increasing. Something has to give. The consumer has to find ways to get around this. One thing that I did find very interesting was if you go back to the Affirm website, so many ways to pay. They have virtual cards. They actually now have a new Affirm card. Affirm Pay in 4 and then monthly payments. So you can make 4 interest-free payments every 2 weeks. What does that sound like to you? If I pay for something every week or every 2 weeks, what does that sound like? Sounds to me like a Rent-A-Center or a Buddies, where I go in and purchase a TV and I'll pay for it weekly. Instead of paying that $2,000 now, I pay $100 or $75 a week. By the end of that TV that was $2,000, I paid $4,000 for it. However, I've made those payments every 2 weeks, every 3 weeks, whatever that is. So it seems like it's better, but is it really better? Now, in this case, you make 4 interest-free payments every 2 weeks. That could say great for everyday purchases. I would argue against that. If you're having trouble making your everyday purchases, I would also ask you, what's your budget like? I would definitely stay away from something like this, even though it's interest-free. Why do I say that? I say that because if you miss one of these interest-free payments, your credit report, your credit score, and your overall loan origination can go through the roof. You can do automatic payments. I have used Affirm before for one purchase. I had no issues. I just set it and forget it. The money was taken out of my bank account every month. There was no issue. But for those that potentially had an issue, or let's just say something happened and I did, that could have destroyed my credit. Now, you can also go over into the monthly payments and it'll tell you what you pay. So it could be 0%, 2%, 7%, whatever. And then those are for more big ticket items. I'm not totally against that because if I had to pay 7% with Affirm or 22% with an Amex, I'll pay the 7% to Affirm. But it's starting to show up everywhere. And as more data comes in, you're starting to see people use Affirm and these buy now, pay laters for almost everything. And that should terrify the American consumer that we're now starting to put everything on layaway or buy now, pay later, and we're starting to pay interest rates on things that we never should have paid interest rates on. And that could be things like maybe new tires. That could be things like I need to get my window fixed, or I need to buy a new dishwasher. I mean, those are things that you know, generally 50 years ago, even 30 years ago, we weren't looking at that. Also, right on their website, it'll tell you real quickly what the total cost would be. So if I do a one payment every 2 weeks, again, like I said, there's 4 interest repayments. I can go down to, I'm not paying anything. I have 0 interest. But if I do the 6 monthly payments, we're looking at 15% APR. So that $2,500 purchase will now cost me $2,610. And if I do 12, it's actually $2,707. Of course, they need to make money. I just want people to be cognizant of what they're doing and where this stuff's showing up. Now, what does this mean for the stock and where's the prediction going? So as student debt rises and the repayments start in October, interest rates for this year, I predict, will continue to go past 8.5%, probably to 9%. The consumer's gonna have to make a choice. What will they do? Either they're going to continue to pay their student debt and they're going to load up on Affirm or load up on these buy now, pay laters, or they're just going to not pay their student debt. They're going to continue to use Affirm and offset that. Or the third option is they don't pay their student debt, they don't use Affirm, they put everything on credit cards, and then we start to pass multi-trillion-dollar levels of credit card debt, which to me is just absolute insanity. Something's got to give, but what I want you to understand is looking at a stock in a company like Affirm, while at the front might not make a lot of sense, once we start digging through and peeling back the onion, we're starting to see that as the economy almost does worse, Affirm does better. And I can prove that by going back and looking at what it was like in November 5th of 2021 when we were in the middle of the pandemic. They had just started quantitative easing back in 2020. They were pushing all this money into the market. It takes a while for all that money to actually trickle down to the consumer. But once it did, look where their stock went. Now, they stopped quantitative easing. They started lowering interest rates, and interest rates continue to stay low. Now that things have gotten worse and interest rates are much higher, so let me go back. As they started to actually increase interest rates here. So as they increased interest rates, the Affirm stock went down. Now, my prediction is when they lower interest rates, Affirm stock starts to go up. We'll have to see. It'll take a year or two for my prediction to come true. If I were going to purchase Affirm stock, I would wait for interest rates to keep going up, because as interest rates go up, I predict Affirm stock will either go down or be neutral. But as consumers start to pile on more debt and as they continue to have to find ways to make ends meet, companies like Affirm will continue to shine. So what do you guys think? Do you think Affirm is a good buy? Do you think there's good data here to predict what the consumer and the economy is going to do? Comment down below, let me know. I'll link everything down in the description. And as always, don't forget to design your financial freedom. Take care. Bye-bye.